and welcome in to Freightonomics, August 28th. August has flown by on us. Thomas Wasson here with me. Again, today is Zach Strickland, and we are going to attack the topic of politics. Not directly, not head on. We're going to try to actually remove politics from a lot of this, the noise and the rhetoric in the supply chain and economic environment right now. You know, my mom and dad always said, never talk politics and religion. And I think the interesting thing about 2025 is it has become impossible to broach nearly any topic. We're going to discuss and break down the rail merger, which of course has now got an added political element to it. We're going to try to pull that apart there. But also just, I think supply chains in general, the economy itself is, you can't escape it. There is this policy, this trade policy that is continuing to weigh on a lot of supply chains, and it's going to be a theme probably for the rest of the year minimum. So we might as well just hit it head on today. What do you think, Thomas?
I mean, we got to. The problem is, in normal times, the supply chain is very dull. It
Yeah.
works. It's kind of like clockwork. One of the big challenges we're facing right now is the policy of uncertainty, and that is impacted by government policy. So when we're thinking about this situation and how we need to digest it, with the rail stuff coming up, especially with orders, trucking conditions, everything right now is downstream of these higher level decisions. I'm going to put on my political science hat because no one ever wants to talk politics. You get a degree in politics. The old joke is it's only useful once every 4 years, and then no one wants to hear about it because they already made up their mind. But one of the fascinating things is when we're looking at it from that standpoint, we have an administration that has been making very large moves and waves in a way that we really haven't seen since I think LBJ during the 60s or FDR in terms of the impact downstream on the rest of us,
Right.
poor schmucks.
Yeah, and the reason that I decided to kind of just lean into it, as much as I try to avoid any kind of thing political, especially on this show, this is a very data-centric show. I like to be as objective as humanly possible. Is that I looked down at my sheet of notes, and there was one item on my notes for today's show that didn't have something directly tied to it politically. I was like, well, you know what? This is what the world's doing. We might as well address it head on. So, Thomas, without further ado, let's talk about some data first and kind of clear our palate.
Palate cleanse.
Let's get some market into here because we got Labor Day coming up. So count me in. Give me a count me in.
3, 2, 1, kick it.
Let's go. Service providers out there, volumes are ticking up in a strong way. And if you look at the previous 2 years, this is what I would say is somewhat unprecedented. It is not a seasonal, this is a much stronger seasonal strength going into this holiday period. Tender volumes, of course, growing this quickly hasn't been a thing in front of a holiday. Maybe we got a little bit of an uptick there at late June in front of July 4th, but not to the level this is. Now, we can't get too excited because we are making up for a little bit of lost time and a little bit of lost volume. We've had a very, very down week August month thus far from the OTVI perspective. So let's go to the next chart and talk about the tender rejection rate also climbing back over 6%. And like I said, this is a little bit out of character for these indices compared to the last 2 years. Didn't really expect a strength of the tender rejection rate coming out or going into the Labor Day holiday period, which has really been soft and quiet the last couple of years. Seeing some decent jumps here. Let's go to the next chart. See where in the United States this is kind of happening. Long haul volumes coming back. This is something the truckload market has lost to intermodal significantly. We're going to talk about the rail mergers coming up, but long haul demand has been crushed over the last 12 months here, starting to pick up. This is replenishment season. I expect this to happen. I did not see it coming to this extent, however, but it's still significantly down year over year. As you see, the city volumes there still holding on strong. No changes there. Let's go to the next chart here. Outbound tender volumes across the country. If you can see this, I can't. It's so bright. But it's anything in green. Those are markets that are growing week over week in the tender volume. So it's pretty widespread. Ontario up there up top, but also Allentown and Dallas showing some decent growth. So this is not just happening in one spot. I talked about long haul volumes, that long haul replenishment freight moving on schedule for trucking I think I have been mentioning over the last several weeks to maybe a few months that I think we have had some concerns around inventories and inventories being a little thin and intermodal kind of losing its utility once a sense of urgency comes back into the market. And I think because we're seeing some of these truckload long haul volumes move, this could be a front end of a little bit of nervousness creeping back into the shipping community.
And one of the conversations we had earlier last time with Dr. Z was that the upstream versus downstream inventory, especially in terms of the LMI data. So, what I'm thinking about is this looks to me like we're seeing the early signs of imagine it's clogged at the top upstream from these distribution
Mhm.
centers and it's staged. These could be these early signs of movement via the long haul moves coming DC outbound to stores and other locations. That's a wonderful sign. I
Yeah.
think you had a good point with outbound tender rejection
Mhm.
rates as well. We normally see a bump if you look at the 2 years worth of data, but this is actually a
Yeah.
rally, which is a great sign for seasonality. But the big question is, where do we go from here?
Yeah, yeah, and I want to pull up. I've got some bonus charts for you today because I couldn't explain the whole story in 2 minutes, and of course a lot of our audience, a lot of our listeners want to see and hear about spot rates. So let's pull up the NTIL here, and then I've got another couple of charts that I wanted to throw at you. Spot rates, not, yeah, we've got a little bit of an uptick in national spot rates. I don't love looking at aggregate spot rate indices because you get mixing and things going on here that kind of mute things. But traditionally, this is a pretty stable set of information. We got a slight uptick. Tender rejection rates tend to lead the spot market when it's an unexpected event. Labor Day, I wouldn't call as unexpected, but at the same time, I think a lot of brokers and carriers out there don't pass along rate increases or don't try to get rate increases unless they have a good reason.
Yeah.
And I don't think they saw this level coming. Like I didn't. I didn't really see this kind of increase in rejection and volume coming. But they also probably have some capacity available right now that they're willing to grab up. But if the volumes continue to stay high, I do expect this index right here to start to tick up. And again, it's a little lagged when we don't see it coming. The next two charts here, Thomas, these are going to be for you. My bonus charts. So this is going to be the truckload national insights from the van and refrigerated perspective. This chart right here, or this page, it's a dashboard, tells you where in the United States. If you look at the right side of your screen, those are the markets where spot rates are increasing the most significantly. The map down there on the left, anything in blue, that's where rates are increasing more than decreasing across the country. So in terms of lanes, I think this northern tier of increases. Now the Pacific Northwest shows up a lot on the right side of your screen. If we go to the next chart here, that'll be the refrigerated one. This was dry van refrigerated, similarly, but much stronger. Of course, the RTI there on the bottom right of your page. A lot of overlap here between refrigerated and dry van markets and spot rates, and in just general demand overall. So that Pacific Northwest corridor seasonally, this is the time of year refrigerated wise. And I think if you're out there looking for loads and volumes, and if you're a shipper out here looking to see why your service isn't top notch like you've expected it to be, these charts and maps can kind of help you see where it's happening.
And you got to think operationally as well from a truckload carrier standpoint. We have produce season. That's why the refrigerated has continued to see a lot stronger posturing compared to dry van. But you got to think about it. Drivers are going home. So that's one of the reasons why you see with the spot rates. I was expecting, putting on my trucker hat here. I should have brought one. But when we're looking at that, you have to imagine fleets are positioning assets to get drivers home for this weekend. And so drivers are kind of the same way. They've got a big question to answer, whether you're an owner operator or a company driver. Do I drive over the weekend?
Yep.
Big question. So right now, if freight volumes are kind of meh, rejection rates around that 5 to 6%, we're kind of equilibrium. That still means there's spots within truckload networks, most likely, in terms of we still need to fill gaps. I mean, I could understand why we would see an uptick because if I'm looking at right now is when what we used to do is calculate who's taking home and then
Right.
what's our working tractor percentage. And so if you're a fleet and you're thinking, well, shoot, I'm losing like 40% of my working tractor percentage, they'll come out. They say Tuesday, but it's really Wednesday. There's some trucker humor here. The driver's like, "Oh, sorry, boss. Yeah, I had too much fun on Monday. I'm actually sick. I can't come out." So we should expect to see a continuing uptick in tender rejection rates as capacity exits the market temporarily for this holiday. The big question that I want to see, especially when we're looking at the NTI and the OTRI, is going to be, will this hold? Because if you look at that historical data, looking at the NTI, it actually dips in the past 2 years. So we know that
Mhm.
that's probably statistically going to be a dip. But if we look at outbound tender rejection rates, we've got kind of a bifurcation. Looking at 2024, we actually saw a seasonal uptick.
Yep.
But then when you go back to 2023, we saw a situation where we were kind of bumping along
Mhm.
at the bottom. So it really is, which way, trucker man?
And I think the increase in volatility from the outbound tender rejection index is still the theme this year. Like, I think most people are still like okay with the service they're getting. The rejection rates are still relatively low from a historical standpoint. We're only showing the last 3 year or 2.5 years of data. If I showed you the pandemic, this chart looks, we squeeze these values with 20% rejection rates, but that's not the case the last couple of years, and we're just slowly crawling towards a tighter environment. But it hasn't cascaded into a kind of that cataclysm that we've kind of expected would happen at some point, but there also hasn't been a catalyst. And we've had this economic kind of environment just weighing on demand right now, and these shipping communities and these companies that are just not investing. And that being said, let's transition into kind of the meat of the show here. And of course, we're going to have to lead off with the rail merger situation. Mike Bowdendistel was kind enough to, I think earlier in the week, and again, theme of the year, what happened, Tuesday's news is irrelevant by Tuesday afternoon. But he talked about how maybe there won't be a transcontinental railroad after all, because as of earlier this week, Warren Buffett states he had no interest, and he's the owner, of course, of BNSF, no interest in the acquisition of CSX. And me and Mike were talking about this in one of our calls the other day. Like, wait, this actually, why would he want this merger to go through? Because if he views CSX as a lesser valued East Coast kind of counterpart to your West Coast network for the rails, because of course BNSF and UP heavily West Coast oriented, and CSX and dropping my head,
Norfolk Southern.
Norfolk Southern,
Yes.
thank you, are very East Coast heavy. The better network is Norfolk Southern. If you're looking at transcontinental moves, CSX is very north south compared to Norfolk Southern. So if he's signaling I'm not going to make this acquisition, that could be a message to the STB. Don't let this merger go through, because I don't think there's anybody out there that sees only one merger taking place. Now, things have changed a little bit this week politically. We'll get to that in a minute. But I mean, for me, breaking this down into a pure business move by Warren Buffett and Berkshire Hathaway, uh, that makes sense to me. Like, why would you want this to go through? And then CPKC also chimed in and said, yeah, and of course they don't really have a dog in this fight necessarily,
Didn't they
but
already just merge anyway recently?
yeah, but they of course oppose all further rail consolidation. They feel like they've got a nice niche corridor there, that north-south connecting Canada, United States, and Mexico, the only rail that can do that. So I mean, unpacking this a little bit, I can kind of see where everyone else outside of Union Pacific and Norfolk Southern are kind of like, this doesn't feel good.
Well, and it also puts in the fascinating thing has been the rise of intermodal trucking carriers and all of that. So one of the challenges when we're thinking of these conversations, like we just saw with Norfolk Southern and their thing, is who's going to be the trucking carrier that helps service it. We've got Hunt, we've got Schneider, we've got Hub Group, we've got all of these companies that have kind of married one of these class one railroads. And if they start shacking up together, is it like a divorce? Do you get to see them every other weekend? Like, there's a lot of challenges operationally speaking when we're thinking of tens of thousands of cars that have been purchased, capital
Mhm.
expenditures and allocations that, I think with the STB, they'll have to take that into consideration. I mean, if I'm Warren Buffett, it makes sense. Put on your MBA hat for a minute. If you're gobbling up the lesser one and then you get issued new shares, are you going to be coming out on top, or are your shares going to be drugged down because you've basically absorbed a weaker one? You don't want to get a case of indigestion.
Yeah, let's also break down kind of like the benefits and problems with this merger overall. Like, I think The pros and cons, if you will. If we had a whiteboard, we'd start writing them out. The pros would obviously be for faster transcontinental service from anybody that is shipping intermodal. And you're going to cut off, 3 to 5 days of layover in Chicago for a lot of people, to where you can then kind of reliably ship across the country without worrying about, that loss of time and space. Now, I don't think that's a huge issue today in this environment, which is why a lot of intermodal has gained so much share over the last 12 months. If we want to pull up the chart that I have of loaded container volumes versus OTVI, which is going to be the truckload tender volume index, this illustrates kind of on paper why, what we see in terms of market share loss over the last 12 months and why I say that truckload has kind of lost it. Um, Not that one. The one that's OTVI, it's the one on top of that one that I have in this chart. But it's basically intermodal has gained share. We've got about a 1%. There we go. About a 1% gain year over year. It's held up. We've had some economic erosion, but truckload up until this last week was down about 15 to 16%
Yep.
in terms of overall demand. And most of it, if you recall the long haul tender volume chart I showed you on the market in two, that most of that volume loss has come for loads moving more than 800 miles. So when people ask, what does this transcontinental merger potentially do? Well, you've already kind of seen it. This year's market is exactly what I would have expected uh, from a transcontinental railroad acquisition or merger that would have taken share from truckload. And I think that's what we see today. So to me, we're kind of seeing it. And I think this market also is a little bit transitory because the sense of urgency will return to shipping at some point, and that will make this rail merger more important to a shipper in the future versus today.
Yeah, it feels like everyone right now is just holding their breath. The supply chain has been holding its breath because of the uncertainty. I spoke with a large OEM earlier for an article, and one of the fascinating things that they told me was, "We're okay with if we have to get tariffs. That's
Mhm.
okay. It happens. We will
Yep.
deal with that. What we can't deal with is if it changes. We need to make sure that it sticks around long enough that we can absorb it or pass it along."
Mhm.
And then the biggest challenges as well, like you said, with the railroads and
Mm.
especially with imports and stuff on the
Yep.
West Coast. Um, this definitely feels like this is one of those sleeper
Mhm.
problems where we're really worried about, okay, let's make a deal, let's get this negotiated trade, blah blah blah, and then finally, the punchline of the joke is shippers going to wake up and go, oh crap, this may be good or this may be
Yeah.
bad, depending upon if you're one of those like chemical shippers who relies on the
Yep.
rail versus if you do have some optionality. It's fascinating because I talk a lot about trucking, but the biggest change over the past 20 years in trucking is you have to also learn LTL and
Yep.
intermodal, and so for the truckload space, this is going to be extremely fascinating because I'm thinking like a JB Hunt or a Schneider. What the heck's going to happen? The final thoughts I had on Buffett as well. This is very interesting because you would assume I at first thought it was just kind of like, well, they're merging. Why don't we merge? It's
Right.
like a little popularity contest. That people will say, no, that's not how it works. Oh, I kid you not. Some analyst at Morgan Stanley was like, hey, I got a great idea, boss. Let me call these guys. But the other thing when I spoke with Stuart Charles and a few other folks in interviews about this, we broke the news. This is going to take like 2 or 3 years
Yeah.
anyway on the east. So this is like a slow moving thing that we're in the very early stages, and so I definitely think we have a lot more to talk about because even if apparently the next step is for this big merger coast to coast, you got to put out your plan. Then the STB has to review the plan. Then they're going to come back to you and say, okay, your plan sucks, change this a little bit. And then you have to wait for the STB to give the go ahead. Then you actually have to. So there's still quite a lot of moving pieces. And that kind of dovetails into the STB news as well, because as I understand it, with this recent news, are they going to be down 2 spots or still 1 spot?
They only need one. And so, as we mentioned at the top of the show, politics has now entered the arena once again, and Donald Trump has said that he has fired the surface transportation member that he appointed in 2020, mind you, a Democrat that has voted against the CPKC merger, as well as another merger in Iowa. But there was no, like, for him to fire somebody, he has to give cause and reason, which none have been given as of yet, or that at least we know about. But it does appear like there is some sort of, political, posturing going on to where they want this merger to go through. Lutnick has supported the merger publicly and said it numerous times. So I don't know the full reasoning behind all this. I would assume money has something to do with it, as it runs our economy. But it is that, to me, kind of, we started off the week saying, oh wait, maybe we're not going to have a merger. This tells me, oh wait, maybe we will have a merger. And now we've got this political influence that is now pushing it back the other direction. And especially if, the Trump administration is signaling that they are for this
Yeah.
merger, it doesn't necessarily have to come with Berkshire Hathaway, or somebody else merging. And that's, again, we've got a couple of years for this to hash out fully.
And one of the fascinating ones is so they can be removed for inefficiency, neglect of duty, malfeasance in office. Those were some of the options. But what's fascinating was before they needed to add the last person, it's currently tied 2-2 along partisan lines. Two of them are leaning red, two of them are leaning blue. So there's a little game theory, because my theory would be, well, if I need to put one more person in to be the tiebreaker, why would I decide to get rid of the guy who I originally in 2020 was the one that I wanted, and then he got nominated through a bipartisan effort, and then he got appointed? There's got to be more behind the scenes, because if we look at it,
Sure.
like you said, just looking at the facts, if you got a 2-2 split and you're adding one more, why would you want to try to definitely change the scales? It's almost like, imagine the Supreme Court and you realized one of them kind of voted a little wishy-washy.
Yeah.
You're like, I'm going to get
Yeah.
this guy. I need that 5-4 is looking a little sus, so I need to make that like a 6-3 or something. So there's got to be something else behind the scenes, especially for a firing like that. That's not a very sexy job. It's not you don't make a lot of waves with
He
the
was
Surface Transportation Board.
fairly bipartisan,
Yeah.
as in by today's standards, for sure. So a couple of more, we'll learn more about the rail situation. We got plenty of time, supposedly, to start to figure that out. So a couple of more stories that came out this week that are worth noting. The BMO transportation, John Kingston writes about this. They, of course, show a slight improvement in trucking credit conditions. They're still bad, mind you,
Yeah.
but we see a little bit of slight improvement in the overall distressed loan category. And that is, I read this and I'm like, okay, some improvement is improvement, but this data has been kind of volatile at this high level of distress. So I'm not willing to say that this is like a trend line that we need to really pay attention to just yet. The next story that came out, of course, the politics has to come back. That was the one story that politics didn't have anything to do with. The feds tell states to enforce trucker English rules or lose millions. Washington, California, New Mexico, of course, only put one out of service. This is a clear political maneuver in my mind by these states to kind of say, we're resisting, or we're just not going to follow through with this administration. These are blue states. Again, trying to stay out of the politics of the situation, but this does feel like a little bit of the politics kind of eroding common sense a little bit. Like, safety is a huge concern here. And I understand there's certain stances that you make, but this one feels like politics has kind of eroded a little bit of clarity over what the purpose is of all of
I'll
this.
give you some backstory on that.
Yeah.
So I was doing some investigative work on CDL fraud. One of the big ones I focused on was whenever we had Arkansas talking about adding in additional work documents for truckers, especially even if you had like a Mexican CDL or something else, or a non-domiciled, you needed to have some authorization. So the fascinating story with this is we've almost seen a reverse. So under the Biden administration, let me preface this by, first off, the FMCSA works like the mob, okay? Every state is like a capo, and then the mob boss is the administrator. What they do is they fund a large portion of your budget to make sure that you do the dirty work, which is enforcement. That's why you have the state DOTs and the state scale houses. A common tactic, if you don't do what they say, is they will threaten to pull your funding, which is happened with Texas in 2021 or 2020 under the Biden administration. This is a fascinating part.
Right.
So Texas said, we want to enforce additional things for not English language proficiency, but for non-domiciled CDLs to validate them. The Biden administration came back and said, don't you do that. We're going to pull your funding. Texas said, come at me, bro. Let's try it out. And then the Biden administration was quiet. So we have set aside an instance where states have defied the FMCSA, in one instance with Texas saying we need extra permits to figure out if these drivers are legit because of cases of fraud.
Right.
The fascinating one on the takeaway with this recent news is that these blue states are saying, well, we're not going to enforce it because we actually have to like add the rule to our books. And since we don't have that rule added to our books that we have to enforce it, I really don't technically have to enforce it yet because it needs to go through my states. And then I have to codify it in laws because that's how the states operate. So
Mm,
the FMCSA sets the guidelines, the states will have to enforce it. And English proficiency is one of those really hot button issues
yep,
because of recent accidents. So this is extremely fascinating because I look at this as part of a larger trend
for sure.
where we are seeing the cracks, the fissures, because right now we have a patchwork of states and a hodgepodge connection. And we have an FMCSA that is, unfortunately, in my personal opinion, woefully understaffed.
Mm,
There's over 3.5 million drivers on the road, and there's 1,100 FMCSA people. The FAA, for instance, has over, what, 45,000 or
yeah.
450,000 people. They have tens of thousands of more people. So it's part of a larger trend. But I do want to say for listeners who are looking into
Mhm.
the political aspect of this, I would continue to expect to see states using this as like a type of bargaining chip. This is part of a pattern of either trying to push back against the administration
Oh
or
yeah, for
push
sure.
back against stuff. It's posturing at the moment.
Absolutely, and that's where I'm kind of like, let's do what's right. Let's do the right thing here. The last story that we have, of course, tariff jitters spark jump in USMCA claims on Mexico-Canada goods. USMCA UMSCA compliance is rising sharply among Canadian 81% in June, and Mexican 77% in June, up from 42% in May. Significant jumps in claims on imports coming into the U.S. under the USMCA protections to try to kind of minimize costs and avoid some tariffs. Now, the trade-off here is that administratively, this is hard to do. This is much harder to like make sure that you're compliant. You have to have years of information and all sorts of stuff kind of tightened up for this to happen. So to see this kind of jump means that shippers are desperately trying to avoid this fallout of all these tariffs and the implementations and things like that. So it is, this to me is going to be certainly something to watch, especially around Laredo. We haven't seen a huge influx volume coming out, not to the scale that this number would suggest, but it's still kind of like you know what's happening. Like this is going to happen, but if shippers are willing to go in this hard on administrative activity to make sure that they can kind of avoid some extra costs, like that's, I mean, and a lot of this has to do with steel and aluminum
Yeah.
imports, and especially they even commented in there that as August 18th, when we got the escalation, there was an even bigger jump.
The
and
raw
and
materials
yeah,
is the big thing. I think, honest to God, that's probably what
mhm.
sparked it. In my personal opinion, is that U.S. UMSA
Yeah,
worked really well when you didn't have tariffs on raw materials. I got to talk with the folks at Volvo, and one of the cool features they have is they have a extra steel reinforced cab chassis, which means that even if you bash it in, you can still open the door. The only downside, though, is that if you have 50% more tariffs on the extra steel you're using to reinforce it, Houston, we have a problem. And so estimates right now is cost between 2 to 3,000 extra per tractor during another OEM I listened to. The big challenge is, like you're saying for this, everyone is suddenly crossing their I's and dotting their T's because
mhm,
you have to squeeze out so much stuff now, especially given the complexities of crossing the border.
right.
Holy cow, I got to have like 5 different documents. I'm on my WhatsApp. I'm like hitting up the importer. It's like you, me, and an extra person. We're all trying to do it. But this is part of a larger trend. So when we're thinking about why are truckload volumes
Mhm.
lower? Why are things in the dumps? Why is there so much uncertainty? Well, it's because despite the fact that we have USMCA or UMSA, which should have resolved this,
Right.
we do have what I'm going to call an activist administration that is, leveraging more for themselves, but utilizing uncertainty as a negotiating tactic, which when we're haggling in traditional haggling, like if Thomas is buying a car, maybe
Yeah.
that's a great deal. But if Thomas has to deal with all the cars imported in the US that were made in Mexico and Canada, it's not as fun for the people who are having to deal with it.
And the interesting thing here is like, a lot of this long-term goal is, on paper supposed to be to bring this manufacturing back into the United States. This is a protectionist policy about trying to bring goods and materials back. Now, if you believe that this is the right way to do it, you still, I think there's still questions around the time frames of implementations, because these supply chains have been built for decades. A lot of the companies that I personally talk to are like, well, we need to make sure that we have some form of like commitment to the long term policy before we invest. The big beautiful bill, of course, has a huge amount of stimulus in it if companies, have this CapEx budget, because you can, of course, accelerate your depreciation into the first year. And it's very front heavy on investment. Yet we haven't really seen the pocketbooks opening from these companies yet. So we've got this strange environment where we can't seem to get out of our own way, because some of the speed. And I want to hear your thoughts on like how companies should be managing this cadence of like implementation, on and off investment strategy. Like what are you hearing? What are you seeing from some of these companies out there?
So I've talked to a few. I'm going to give
Mhm.
you an example. I'm
Yeah.
going to use an allegory here. They're not usually the best for making a point in terms of arguing, but they're useful as in we're holding our breath right now. If you're a company, you need to ask yourself, how long can I hold my breath? What I mean by holding my breath is how long can I stockpile inventory?
Mhm.
How long can I handle having inventory upstream? Do I normally, like one company I spoke with, she orders her stuff from overseas a year in advance.
Mhm.
Can I be able to afford if I need to either bite the bullet now and bring it in and hopefully maybe a duty-free
Mhm.
warehouse, or do I hope and roll the dice, roll them bones, and see if Q4 comes up during traditional peak season, the capacity is still plentiful enough, and that despite the higher tariffs, I can still handle it. That's the big question. That's even from OEMs and other people I've talked to. Everyone is telling me in some form or another, I am either holding my breath or I'm having to bite the bullet, but I know by next year I need to do something. So I think the biggest challenge heading into the end of the year is look and see whose faces are turning purple, because there
Mhm.
is right now two sides to this play. We saw earlier with the
Mhm.
front loading of tariffs and the extensions, we saw, maritime shipments come and, really up and down out of season where people are taking advantage of it. But then we still have that group that's waiting to see. And that's good or bad, I don't know the answer to that, but my personal thought is that what happens when you exhale and then you have to start buying these products and doing these replenishment cycles with either different nations. We're seeing Vietnam make some changes, or paying the additional duties and fees, the de minimis exemption stuff. That is another huge thing. We've got stories now, like I guess Switzerland. If I want to order something from Switzerland over a certain dollar amount, they're just not going to ship it, which is kind of like some countries are straight up because of the de minimis. They're like, I'm not shipping things. And
Yeah.
so, I mean, you've got to imagine we're used to a supply chain that would take years to negotiate a trade agreement.
Right.
Things were chill. We kind of got to do our little thing. Um, I would just say if you've got to exhale, see how long you can hold your breath financially speaking. If you've got to bite the bullet, make sure you've got a plan. If you do have to exhale, have relationships with carriers, importers, try to find bonded warehouses. You basically have to come up with like three different scenarios. And, this is not financial advice, but I want to make sure that if I have a situation with inventory, I'm in a good spot. And the biggest problem with consumer and everything else is we don't even know what a good spot is.
Yeah, and then in these companies, and I've got the squad working on a chart here with some data. These companies are, it takes typically months to years to negotiate procurement deals with these exporters from across the globe. Like this is not something like Trump is basically negotiating or trying to accelerate his own timeline, but that's not necessarily translating to a lot of these other businesses. They're still on their old school timelines of negotiating these trade deals and locating the right places to negotiate these deals. And that's why a lot of reason we haven't seen some of this tariff stuff manifest just yet, because all of it has been just in case. Let me order a bunch of stuff in front of the tariff implementation, try to get around all these tariff costs. And it hasn't fully flushed itself out yet because nobody has enough clarity to make that happen. I want to pull up the IOTI, and thank you to the squad back there. This illustrates what shippers are dealing with right now. This is a very volatile looking chart this year in white. Now, the last 2 years, I wouldn't consider normal by any means because we came out of COVID. Things really haven't been normal since COVID from an import standpoint. And you've got the 2023 market there where we had the oversupply of inventory. You've heard Dr. Rogers, come on and talk about how we had this glut of inventory. We had Samsung, Walmart, Target all say we got too much stuff because they over ordered during the peak of demand at the end of 2021 when consumers were really, on steroids and overstimulated. Well, that fell off. And then, so they spent most of 2023, and you can see in the pink line there, fuchsia line, how it looks like inventory's kind of normalized. Then in 2024, the story was, you know what, the Red Sea,
Yep.
I don't know what's going on with that. There's some port strike activity that happened later in the year. There were concerns building around that. There's a lot of uncertainty around how the freight was going to get to the United States. So in 2024, the Green Line there, we saw this buildup, but that was kind of that was like we're building inventory now above where we need it. This pull forward type activity that was sustained through the back half of the year. Then enter this year. It looked like we were going to normalize the little spike you see at the beginning of the year. That's Lunar New Year. It's very seasonal. It happens every single year, pandemic or no. And then we had this big dip in May. That was the air pocket created by the cost prohibitive tariffs on China, 145%. That went away. And then we got a makeup time, which led to what is traditionally a little bit ahead of peak season, end of June, early July, import activity. So if you almost put the
pull forward,
the top and the bottom together, there's just a little bit of pull forward in that net of imports. So when we looked at the LMI the other week, it was at a 55 on inventory level. That was just a marginal growth in inventory levels, including that peak. So we're not seeing Dr. Rogers, of course, splits it into the up and downstream. We didn't see inventories grow to a point like we saw in COVID where they were like, just open the wallet and order everything. So investment is still very much tamped down. And we still have a shipping community that is still trying to navigate a very thin line because inventory costs are also exponentially higher. And I think until we get some certainty here, and we're not going to see that change. However, the consumer, the consumer this year, if you listen to Walmart on their earnings call this quarter, they said, we had a pretty good back to school season. Now, this back to school is a signal for them that the consumer's doing okay enough to buy some presents around Christmas. So they're actually signaling that they expect a fairly good fourth quarter, which means if we don't have enough inventory in this country, if we haven't ordered enough, this index, the IOTI, and then subsequently the OTVI, because intermodal's value kind of drops without that transcontinental merger happening in the fourth quarter because the sense of urgency is too high.
Still got to go to Chicago. You still got to deal with the hubs and the bumps.
You can't risk the congestion because infrastructure around intermodal is very static. They can't flex outside of adding some, containers to the trains. And this is an inherent risk in the fourth quarter. It may not be the sustainable flip that, a lot of people are looking for in the truckload space, but there's certainly a risk that they don't have enough inventory. Therefore, they're going to turn to the truckload market, which has been cake to navigate from a procurement perspective. And the sense of urgency for the holidays is always high.
So I got a spicy take for you because I'm starting to think with the LMI upstream versus downstream. There's got to be something. Why is it that when we looked at LMI, downstream was poo-poo on transportation prices, downstream, contraction, they're letting it bleed off. That explains our spot market rates. Our spot market rates have been poo-poo as well because downstream is where the smaller fleets and owner operators and brokers, they really love to congregate. Upstream is where typically the big boys play, like a US Express, the Knight Swift, a Schneider, a JB Hunt, because upstream is normally DC to DC or inbound to DC, drop trailer, large high volumes. And so the fascinating thing is when we saw the increase upstream, we've also seen the increase in outbound tender rejection rates. The big question is, and I'm tying it all back to holding your breath and exhaling, and you suddenly got to go, I need more stuff, is going to be, will we see a bleed off? And we should, going through not Christmas, but Halloween. We got the Halloween crap. I don't know, Thanksgiving crap. We've got little home goods. We've got all this
stuff. Is there
stuff.
Thanksgiving crap?
Is there, there's like cornucopias. But if we see enough of this, my theory, and that's what I want to find out, is going to be is if this longer haul replenishment, which it makes sense because over a certain mileage band, DC outbound to store and DC to DC transfers, will that be enough to help buoy the larger carriers to get maybe another single digit rate increases in the upcoming RFPs? That's one of my big questions that I'm going to have to find answers for. You can email us as well and let us know. The second question is, will there be enough spillover to where that extends into this downstream DC outbound store to where either carriers it's matriculating into the spot market, or we may see a situation where spot rates meaningfully rise. And
Yeah.
I'll call that a win if we're up like 5% year over year. I'm not. That's the problem. After COVID, we had such gangbusters. It really kind of put a weight on expectations of what good looks
Mhm.
like, because it was just stupid good. And so, I mean, I think the biggest thing is if we see a pattern, and Dr. Miller, Jason Miller, he has on LinkedIn, he has some really good posts talking about he doesn't expect, he thinks it's going to be a wash
Yeah.
because of some of these more tariff induced changes and some of this
Right.
domestic manufacturing, which is a big chunk. So that's kind of it. It's funny. It's September, October, and November. Not only did an OEM tell me, Thomas, we got to look to these 3 months to see if
Right.
it's going to be good, but we may also see in the broader supply chain if these 3 months are going to be a crystal ball to see how if the freight recession is going to go meaningfully upswing, or if it's going to be up, down, reset, and we just roll the dice again coming in 2026. It's really fascinating. This is I don't like to hype it up because I know college football's starting, but in the supply chain, the season is starting as well.
Yeah, I'm with you. So I'm going to go into analyst opinion mode a little bit. If we can pull up the outbound tender rejection index and kind of I want to kind of apply some of this forward looking. Fourth quarter is about retail.
Yep.
That's retail's time of year. Manufacturing's over. We're not worried about it right now. The consumer drives the American economy, and so this is what gets put on trucks in the fourth quarter. The manufacturers kind of go to sleep because they got these big holiday periods. They shut down the manufacturing processes, especially domestically, because it costs too much money to turn those machines on and off. So what moves this time of year is the finished goods on the retail side. So looking at this chart, you see how noisy this thing is. Last year was actually considered a fairly, it was a recovery year for the truckload market. And it wasn't that noisy. We had this kind of stable, we had this long haul surge in the middle of the year, replenishment, pull forward freight coming in. And then it kind of stabilized the port, and we had Hurricane Milton, Helene, et cetera, kind of bumped us up, and then it kept growing. My thoughts are we don't have that kind of consistent down and up. My thought is we kind of flatline here. We got a Labor Day spike that's happening outside of schedule. And again, I'm ignoring any exogenous factors like hurricanes and things like that that may come up. I think we have a pretty sharp movement this winter based on the volatility that we've already seen in this index this year. And these are minor-ish events. You've got tariffs. You've got July 4th, which everybody knew was coming. You got Road Check Week, which again,
we're in the middle of brake check week right now,
Yeah.
actually. So that's another event where we're actually seeing the
Yeah.
market. There's been so much news. I didn't even
Yeah.
get to fearmonger on hurricanes. I couldn't fearmonger on brake check week. It's like mongering, but there's too much mongering. And so I think that English language proficiency mongering, it's a monger's paradise right now, folks.
Yep.
But yeah, I think what you said, I'm going to reiterate because pull up that chart one more time. Look at the split. So it's almost like we're running a race. We got a lot of gas in the tank. Look how elevated tender rejection rates are. Right now, reefer is good. Flatbed is good. Dry van is the slow and steady tortoise. We need to see if that bro's going to get some legs. But one of the things I want to see is if by September, October, and November, do we trend down or do we continue to trend up at a higher rate compared to the previous year? It is. I think that's the point. Look at this bifurcation right there in the middle of September.
Right.
That's the money shot in the words of Michael Bay.
I mean, it's interesting to me to see how different these markets are behaving from a tender rejection standpoint because rates don't tell this story.
Yeah.
Because it's still all soft. It's just layers of softness that the rates don't really tell you. Because unless there's a reason to like get aggressive with pricing, I'm a former pricing guy. You don't take that risk, especially when you need the volume. So right now, this is kind of the underlying signal. We've talked about it for 2 years now, and I'm almost kind of over it myself.
Yeah.
But this volatility that's starting to show up is starting to become unignorable. And I think we're going to have a story in the fourth quarter that a lot of these carriers and brokers are going to have. And then the shippers are going to for sure have a sense of urgency, unless they prepared, mind you. But the rate data doesn't support the fact that a lot of these shippers have taken precautionary measures into trying to avoid some of this risk because we've seen rates start to kind of creep lower.
Yeah, we have a lot of I think we have a
Mhm.
lot of alpha, as the
Yeah.
stock bros would say, especially
Mhm.
leading indicators and OTRI. We've got a lot of great stuff.
Mhm.
The biggest question is going to be, are we going to see a real strong first half into this peak season, kind of like
Yep.
football? Are shippers able to make halftime adjustments? And secondly, do you have the depth if you're a carrier or a shipper in the event we start seeing riding guide failures? Who knows? It's really early, but guess what? We'll definitely have a lot more stuff to talk about at least.
All right. Well, thanks for hanging in there with us for the 45-minute special episode of Freightonomics this week. We will see you in 2 weeks. And we'll have a Labor Day update at that point. And guess what? That'll also be peak of hurricane season. So hang in there and have a great holiday.